Investing is like a game where you have limited tools to start off. And if you lose all your tools, then game over. Hello and welcome to another awesome episode of Moneywise. We help you to make sense of the world of personal finance and investing. In today's episode, I'm going to share with you how you can improve your cash flow management and build up your risk capital. First, let's structure your cash flow. We will only be looking at your net take-home pay and not your gross income. Basically, we will be looking at the regular amount you receive in your bank account on payday and how you use that money. So, how do you spend your monthly cash flow? Well, imagine your cash flow as a rectangle, and in this rectangle are all your payments and expenses. Take note, when doing your income rectangle, for the accuracy of each component, you need to include all related expenses. For example, if you owned a car, you'd have your monthly loan repayments, but also things like your monthly petrol bill, cost of servicing, season parking, ERP charges, and of course, road tax. Also note that you should have a tax provision for yourself, which means you have an estimated cost of your income tax in mind. This is a good practice, and it is not difficult. Just visit the IRS website and look up your tax bracket to see the estimated calculation. Now that you have an accurate income rectangle, there are some very important questions to ask. Like, what can influence your income? There are two types of factors that can affect your income: the external and the internal. External factors are things you cannot control, like the global and local economy, your industry, your company, and even your superiors and colleagues. Internal factors, however, are things you can control, as these are your personal spending choices. These choices have a real impact on you and your income. For example, if you buy an expensive luxury car, there is an opportunity cost because this money now cannot be invested to grow your net worth. The next question is, where do your investment funds come from? For this, we go back to the old saying, never invest what you cannot afford to lose. Hence, you need to budget accordingly so you do have money you can afford to lose. This is where we improve the income rectangle by adding a new component called risk capital. Risk capital comes from your monthly income and you budget to set aside an amount you are comfortable with. It is money you can afford to lose because you've budgeted accordingly. It is like an arsenal that you build up to give you attack options. Investing is like a game where you have limited tools to start off. And if you lose all your tools, then game over. So it is also wise to test water to protect what you have while trying to gain more. So when an opportunity arises, you have the money to take advantage of it. Otherwise, if the property market or stock market crashed, you wouldn't have the money to invest anyway. And here's the cool part. Investments that grow or contribute to income increases your risk capital. With more risk capital in hand, you can take advantage of even more opportunities. For example, if you invested $1,000 as risk capital and it grows to $10,000, your risk capital is now $10,000. Now just repeat the investing process. Aside from the usual asset classes for retail investors, risk capital can be used for other opportunities too, such as e-commerce or startup capital for a friend who is looking for investors or silent partners in a business. To wrap up, in this episode, you have learned that in order to invest without worrying too much, you need to budget accordingly for an amount that you are comfortable risking. Now that I have talked about your arsenal, join me again in the next episode where we will cover the importance of having an armor, that is, your savings. Thank you and see you again for another awesome episode of Moneywise.